Good morning. This is Andy Cates from the Global Economics Department at UBS. The fear of a deep and broad-based global recession is haunting the investment landscape, with equity markets everywhere suffering steep declines overnight. Safe haven assets and currencies such as government bonds and the yen have been receiving some fresh bids. There's a great deal of conjecture, meanwhile, in the markets of large redemptions from hedge funds, more commodity contract defaults, and hefty FX-related losses. Whereas many investors with a global hat on had believed that the global financial storm had been contained to the developed economy complex, with only limited spillovers to the emerging world, the truth now appears to be far less rosy. From the Ukraine to Hungary to Argentina and back again to Russia, emerging economies are being placed in the spotlight as one by one they begin to crack as the credit crisis breaks the proverbial straw on the camel's back. We will not wade in this forum into the specifics that concern the outlook for many of these individual economies, though in a highly generic sense, the role of falling commodity prices should not be overlooked, in the same way that falling house prices shouldn't have been overlooked a few months ago for the US and for many countries in Europe. We would draw attention, though, to a research item that's been published by our EMEA team this morning that looks in some details at other generic issues that are plaguing the outlook in Eastern Europe in particular. The team argues that it's the countries with relatively liquid markets such as Hungary, Russia, Turkey, and South Africa that are being hit hardest so far, even though most of these don't confront some of the deep-seated macroeconomic and financial issues that confront many of the others. And these would include the likes of Estonia, Latvia, Lithuania, Romania, and Bulgaria. As regards the outlook going forward, we'd expect to see further policy responses in some of these economies, perhaps in the form of rate hikes, FX intervention, IMF assistance, and possibly even ECB involvement, if that is, the crisis continues to erupt in a systemic sense. Indeed, when we combine the issues in East Europe with the issues that are confronting, for example, Argentina, it's probably safe to suggest that emerging market risk premiums will continue to head higher for the time being, and that rather obviously the downside risks to growth forecasts in the emerging regions are rising rapidly. So much, in other words, for decoupling. For the developed economy world, of course, the same to some extent holds true. Via trade and financial linkages, the world economy has never been as intertwined as it is right now, which incidentally was always the main reason to pour scorn on the decouplers. Via these linkages, growth in the developed economy world could be even more soggy in a systemic emerging market crisis, and the policy response from central banks and governments could be even bigger than most are even now prepared to contemplate. Overnight, for the record, the Reserve Bank of New Zealand has delivered a fairly aggressive policy response in the form of a rate cut of 100 basis points, so this was admittedly in line with expectations. In the day ahead, the calendar is pretty bare as regards economic events, with just the latest claims estimate on offer in the US. The UK sees some retail sales data, while France sees some consumer spending and ANSE business confidence data, all of which are unsurprisingly expected to be pretty soft. That's all for today. Thanks very much.